My name is Gina Behrens. I'm the Chief Operating Officer for the Chamber, pinch hitting for our CEO, Scott Miller, that had another meeting that he had to attend. Um, I wanted to just first introduce our wonderful sponsor for all of our small business universities. This is a new partnership in the last couple of weeks, and the Payroll people. We are excited to have Craig Donaldson on board, Vice President of Client Excellence, which I love that title. So, Craig, welcome this morning. If you'd just like to say a few words to the group.
Thank you, Gina. As you mentioned, my title is the VP of Client Excellence. I am in my 40th year with the Payroll People. Um, Payroll People is locally owned and operated right here in Fresno, California, with our headquarters up in North Fresno. Um, this year in business, we are celebrating our 45th year starting January of 2026. Um, our goal is to combine excellent customer service with best-of-breed software to provide a unique and great experience for our clients. We're extremely happy to be partnered with the Chamber. As Gina mentioned, our newly formed partnership, excited about that. And finally, our goal is really to make business easy for our clients and anybody that we interact with. With that, Gina, I'll throw it back to you.
Sounds great. Thank you, Craig. And I have to say, as a new partner and also client of Payroll People, thank you for making it the learning curve just a little easier for us. So we are enjoying getting to know the technology and moving forward. So thank you for that. We appreciate it. And your
Wonderful.
sponsorship of all of these really important topics that we discuss. So let's get into it. Shelton Autry, thank you. We are excited to have you, recent graduate of Leadership Fresno, another chamber program. So thank you very much for that. I'm sure that was an experience. So we're happy to have you. Shelton is the managing partner for Bean Hunt Harris and Company with over 10 years experience in this field. So we are incredibly grateful for you to be here to share your expertise on this topic that I'm sure is very confusing over the last few months as this come into play. So we will turn it over to you. And just for the group, after Shelton's presentations or during, please put your questions in the chat box and we will get to those at the end of his presentation.
Thank you, Gina, and thank you to the Chamber. As Gina mentioned, I just graduated Leadership Fresno, class 39. We were the best class ever, but we went with the slogan that we raised the bar just because we didn't want to be that pretentious, but I think we all believe it. And funny enough, with Craig joining um, this webinar as well, we're also a client of Payroll People. So you just have a bunch of clients all over. And we've been very happy with the service of Payroll People. And yeah, so I will share my screen and get started with my presentation. So hopefully I can do this right. Okay. So everybody should see the presentation now. Just be on the first slide right there. And so yeah, thanks for watching. There's been a lot around this topic, really since probably last year around election time when you had both sides, Republican and Democrat, talking about the changes that were going to happen because the TCJA, the um, tax law that was implemented when President Trump first came into office, was set to sunset at the end of this year. And so something had to happen. And it finally did. And there's a lot of misinformation out there, but hopefully, just skimming the surface now, you'll be better informed and can talk with your tax professional, your CPA, and be able to have a full discussion and hopefully, help save you money and keep you compliant. So Gina already talked a little bit about me, but I have over 10 years of experience in the field. born and raised in Fresno, went to Fresno State, and from that point went to a larger firm in Portland, Oregon, then worked my way back down to Sacramento. And then when my son was born 7.5 years ago, finally moved my way back here to the lovely place of Fresno, California, where I'm talking with other Fresnans, so I can say I live in Clovis. But when I talk with everybody outside of Fresno, Clovis, I just say that I'm from Fresno because it's an easier point to find on a map. And I've been the managing partner of Bean Hunt Harrison Company since last June, and we're a full service CPA firm providing services to all the way from individuals and small businesses to mid-size and large businesses. We perform tax services, accounting services, assurance services, forensic accounting, valuations. But really, right now, the topic is tax law and making sure that we're all on the same page and understand what all this craziness is. And hopefully, from that, can benefit a little bit because all of these tax law changes are really just President Trump and his administration telling us what he wants us to do. Now, you don't have to follow it, but if you do what he says that he wants us to do, then there could be some tax savings. So hopefully some of that will reign true with some of the things that you're doing, whether as a business or an individual, and you will be able to save some money. And so I'm going to go over this in two different phases. One will be looking at the business side and then the next individual. I know here we're mostly businesses, but if you're a pass-through entity, then you get taxed on an individual basis. So that's why it's just as important, as well as maybe it's important for your employees as well. And so the One Big Beautiful Bill Act, which fortunately for President Trump, I love the way that he names things. It's always something that doesn't seem like it would be coming out of the White House, but it does. And it's just a fun thing to say. And so it was signed on July 4th of 2025. And what it mostly did was extend a lot of the old items that he had put in place when he first came into office. It would be standard deduction, the tax rates being similar, and then some other changes that we'll talk about as we go through this webinar. But what it also did is it repealed some things and sort of focused in on what is important for him in his administration. And one of the things here that I have on this slide, the repeal of energy credit and incentives. So buying a electric vehicle will no longer provide you with a tax credit at the end of this month. So if you were ever thinking of buying an electric vehicle, I would go do that now and make sure you get it done before the end of the month because you have to take delivery of it. It has to be in your possession for you to be able to get that tax credit. And then I will sprinkle in a little bit here and there, but California, of course, is different. A lot of states are different. So I don't want this to seem like in many instances we'll be bashing California. It is sometimes a hard place to deal with all of the tax rules that California has in place. But we'll talk a little bit about some of the ways that California conforms to the federal tax, ways that it doesn't conform. And then I always just want to put giving free advice on things, or even if I was giving you free advice and we were just talking on the phone about your personal situation, maybe I wouldn't say this, but I'm not talking to anybody individually here. So please don't take anything I say during this webinar as it's going to be absolutely true in your situation. There's a lot of different items within any of these different statutes that have come out that I won't be hitting the really fine-tooth comb of what may apply in your situation. So just be aware of that. We're just skimming the surface and just trying to give you an idea of what some of these changes are so that you can go and talk to your tax professional and make sure that you're on the same page with them and can use these tools to help save you on taxes. All right. So we'll go through some of the business updates. One of the main ones that I think everyone is ecstatic about is the reinstatement of 100% bonus depreciation. And so what this means is that you'll be able to buy equipment and depreciate it 100% in year one. So you buy something for $20,000 and you can see a $20,000 deduction on your tax, which of course will save you in taxes. Now, there's other caveats to that of there is recapture whenever you sell that property. So just some things that you want to think about, and something that I think a tax professional would be able to tell you, as opposed to something you may hear on TikTok or YouTube of some random person saying, "Hey, go create an LLC, buy a vehicle over 6,000 pounds, and I can just deduct it right away. You know, here's this Lambo, I deducted it." That may not be the best people to follow in terms of tax advice. But what I will say to that as well is CPAs inherently are very conservative, and I'm a very conservative person. But you don't want to be one side or the other. You don't want to be on the side of, okay, we're going to do everything and we're going to deduct this, deduct that. And then you also don't want to be on the side of, hey, we shouldn't try and go after this new tax law because maybe I'm just conservative, maybe I don't understand it enough. Um, and I just want to put the most conservative numbers on your tax return, and you could be leaving money on the table. Most CPAs are usually somewhere in the middle. And what it really requires for all of us is just to have the conversation and to communicate about these things that are going on, and to make sure that in your situation that we're all doing what we need to do to help you, the client. And so a few of the other things that we'll take a deeper dive into in the later slides are a new class of qualified production property, which in the Central Valley will be probably more focused on, could be a manufacturing facility or a processing facility for an agriculture operation or farm. Updated Section 179 expensing limits, which isn't as important anymore with 100% bonus depreciation, but I'll explain why it may be important in some instances. And then reauthorization of some qualified opportunity zones, which is a bigger deal here in the Central Valley, as we have more of these zones just due to the area that we live in, as opposed to if we lived in like LA or the Bay Area. All right, so bonus depreciation. It is for equipment purchased after January 19th, and it has to be something that is entered into after January 19th. So just be aware of that. If there was anything that you did beforehand, it may not qualify. You also at that point probably weren't banking on there being 100% bonus depreciation, because this was something that was signed in after that. But take a close look at any transaction that you did before that time and talk with your tax professional just to make sure that it is something that you can take. And so there is a transition period that's allowed in the first year. And so there may be instances where you don't want to take 100% bonus depreciation. It could just be for tax planning purposes, net operating loss reasons. There's not as many because the bonus depreciation does allow you to take losses, as opposed to Section 179. You can't take losses, which just means if you have taxable income of $10,000, you can't Section 179 $25,000, because then you would end up in a loss. But you can bonus depreciate $25,000 and end up in a $15,000 loss with bonus depreciation. So again, something that just requires you to talk to your CPA or tax professional and just make sure that you're doing everything right for bonus depreciation. But definitely an area that I think will be very fruitful for a lot of companies here in the Valley, of being able to take in that deduction immediately, which really at the end of the day, the goal and the reason why things like this are in place is to increase spending, right? I think in President Trump's mind, of domestic produced products. And then one of the areas that is actually really, really intriguing is this qualified production property. So what the One Big Beautiful Bill Act did was say that if you build a qualified production property, then you can actually deduct 100% of that property immediately, as opposed to amortize or depreciating that over whatever its normal useful life would have been under the old standards. And so what this really tells us is that President Trump and the administration is trying to say they want us to build new factories and buildings to produce products in the United States. And if you take that direct message from him and it's something that you were planning on potentially doing, then that's something that you can go about and do and actually have some tax savings. So this is also another instance where it requires proactive planning. So you don't want to go about actually producing this building or producing this property and then talk to your accountant in March of 2026. Or, in each subsequent year, you talk to them around tax time, right? Because there may be stuff that's within this within the standard that requires you to have within contracts or to make sure that you have in place before you even start building. So something just to think of. I think this is a great opportunity if you were planning on building any property within your business to produce a product, which it's a very broad definition, but really it's just in any instance. If you're producing something here in the United States and this property is going to help you in producing that, then it would qualify for this. And so I explained it a little bit more here in this next slide right here. And one thing that I didn't mention is this property, the only portion that will apply to this standard is the actual portion that's producing. So you can't build something and then write off the offices that you put in there and the parking lot that you put in. It's only the portion that is actually doing the production. And then so you see the example here that I already mentioned of, I think, being more applicable here in the Central Valley. It could be farming. We have a lot of manufacturing as well. That's something that if you were planning on building that new warehouse anyways, then this would be a great time to do it. All right, so a few ways of how to use it. I already mentioned if you buy just standard equipment that you were going to buy anyways, could be office equipment, could be computer equipment. It will apply here. The one item that is important to note, and I mentioned before, of the TikTok influencer saying 6,000 pounds or more. And the reason for that is if it's less than 6,000 pounds, then there's limits on bonus depreciation, as well as the Section 179 deduction. And the reason for that is more of a passenger vehicle, and they're not going to let you depreciate 100% of that. But if it's over 6,000, then they will. But one thing that I really want to reiterate here is when trying to depreciate a vehicle in your business, it has to be for business use. So it has to also go above and beyond just commuting from your home to your office. You actually have to be using it to go to client sites, to go to ranches, and you have to be tracking your mileage as well, so that if the IRS ever were going to come in and ask you more specific questions on this vehicle, that you would be able to prove to them that I do use this vehicle for business. And so the line usually that is used, because as I was talking about there, you may think, oh, well, sometimes I use it personally, which is okay, is it has to be 50% or more used for business. And if it's not, then you're really better off just potentially reimbursing yourself for mileage. There's a little bit more nuance to that as well. To have an accountable, make sure you have all your ducks in a row. But really, you just want to make sure that it's 50% or more. And at that point, you can put it on to your books and depreciate it there. But if it's less than that, it may just be more worth it to give yourself the standard mileage deduction, which I think it's like 70 cents a mile right now. I know it's increasing in 2026. And then just track the mileage that you're using for, and then you can just send yourself, you know, checks or I think there's other bookkeepers on the webinar as well. You know, there's other ways that you can reimburse yourself that way. And then California here, lucky enough, does not have bonus depreciation. So there's always going to be a difference in what you have on your federal tax return versus your state tax return when you have this bonus depreciation here. So something to think of. You know, you may be reducing your federal bill, but California may come around and you'll have a not as big of a tax bill because the tax rates aren't as high as federal, but it could be something that pops up that you weren't thinking about because you're going to be, you know, net zero or a loss on the federal return, but California, you may have a gain. All right, the section 179. So the new bill increased the maximum deduction to 2.5 million with a threshold of 4 million, which just means if you purchase more than 4 million, then your deduction will go down. This is going to be adjusted for inflation, which a lot of items here will be adjusted for inflation. And as I mentioned before, Section 179 creates can't create a loss. Sorry, bonus depreciation can create a loss. So that was one of the caveats with Section 179. Like, yeah, it was a great way to be able to depreciate things immediately. But with it not being able to create a loss, if for tax purposes you're already at or near a loss, then it wasn't really useful for you. But in some instances, Section 179 may be better than bonus depreciation. And that could be if you have an item that you were hoping to do bonus depreciation for, but you weren't able to because it didn't qualify. And that could be like HVAC systems, fire protection systems, security systems, things like that. Yeah, it'll be, you know, sort of beating a dead horse, but you know, talk with your tax professional and get into the details on your situation, and they'll be able to point you in the right direction of which program's best.
Hey,
And
Shelton,
another area, go
Shelton,
ahead,
real
sorry.
quick, just before you move on too far, there was a question on what kind of property would be eligible under my understanding. I believe it was the building part that you were talking on a couple slides back. So can you elaborate a little bit on that?
Yeah, so it's anything that goes into producing a product. So the easiest way I can think about it, because I usually relate a lot of things to farms, is if you build a new shed on your farm to process the fruit. It could be, you know, you just put it into the warehouse and maybe you clean it there. Maybe it's not exactly packaged there. Maybe it is packaged there. But if you have something that you're building new relates distinctly to the production of a product, and product doesn't have to mean like iPhone, it could mean food, then it will apply for that. And now there's other nuances to it that would require a deeper dive, but it really is only for the production of new facilities and only for the portion that relates to the actual production. So if anybody is even thinking about the possibility of building a new warehouse or factory or shed, talk with your tax professional and see if this is something that would apply in your situation and potentially could, you know, reap a lot of tax savings, which will ultimately be offset by the cost of actually building it, which, you know, is ever increasing. Um, but yeah, if you were thinking about doing this, then now's a good time to talk to your tax professional. If you weren't thinking about doing this, uh, and now you are, great. But if you're thinking about doing it just because of tax savings, talk to your tax professional because a lot of times, you know, we see this in many different instances of doing something just because it gives you tax savings. Well, there's a cost to everything. So there's a heavy cost to building a whole entire new production facility. And from a cost benefit analysis, it may not be worth it for your business. Just because it saves you in taxes doesn't mean that it's something that you should be doing.
Thank you.
And I hope that answers it. And I don't think I have my email in here. But at the end, I'll put it in the chat. It's just Shelton A at bhhcpas.com, or you can just contact us through our website or talk to your own tax professional. Always more than willing to take a deeper dive into your specific situation and talk through if any of these areas may be applicable to you. And so another one that provides quite a bit of tax savings is research expenditures. And under the old rules, there was something that had to be amortized as opposed to being deducted immediately, which could be difficult on businesses, especially when you're doing a lot of research because you're spending a lot of money but not getting the benefit immediately. And so the new tax bill allows full expensing of this, but you'll see the item right here, this one word, domestic. So if you're doing domestic R&D, it applies. If you're doing foreign R&D, it doesn't. And again, it just goes back to, it's very black and white. This is what the Trump administration wants, is to focus on the domestic side and not the international side. And so almost all of these new items within this tax bill will relate to that. And so there's also some special provisions for past R&D expenses. And so for small taxpayers, which is just less than or equal to 31 million in gross receipts in 2025, you're actually able to go back to 2022 and amend your tax return if you had research expenditures and take those immediately as a deduction. So that's really great for small taxpayers if you had a amount of research expenditures in those years. But also, even if you're not a small taxpayer or you don't just want to go through the hassle of going back and amending those returns, then available to everybody is a way to accelerate your research expenditures in the future, meaning that over a 1 or 2 year period, in 25, 26, you're able to fully deduct those research expenditures. It's our other favorite topic, meals and entertainment, is something we all spend a lot of money on, whether it be with clients or with our own employees. Not too much changed, but the one area that did drastically change, which may or may not be a big impact to your business, is that meals provided for convenience in 2026 will no longer be deductible. And so what this means is your office snacks, your office coffee, you can't deduct anymore. So that sort of sucks. In our office, we provide snacks and drinks. I don't think any of that will change. It's sort of a set standard now, I think, in a lot of different places of providing those things for employees in a way, to keep people happy and fed. But no longer will it be deductible. You'll see here as well in this this table that there's client entertainment, 0% federal, 50% state. I want you to know this is all a generalization. The 50% deductible for state doesn't mean that you can go take a client to I don't know, Pebble Beach and spend thousands of dollars. It just means that in specific situations, you can deduct 50% under state rules. But doesn't mean that you can just do whatever you want. So take this table as sort of a reference guide of what can be done. But again, if you want the specifics behind it, you can reach out to me or you can talk with your tax professional before you go to Pebble Beach and take your client. All right, and just some other ones that I thought were important to note, but not going to take too deep of a dive in, are some extended credits available to employers. The paid family and medical leave credit, employer provided childcare credit, which you get a higher credit for eligible small businesses, which would just be the same threshold as I had mentioned before. New markets tax credit, it's something I've seen several different clients take here in the Central Valley, has been extended. I think there's a lot of opportunity to, be able to create a credit for yourself or for your business, and it just requires a deep dive into understanding your business and your operations and your goals, and potentially aligning those with credits that can help save you money. And then the last thing I'll mention here for businesses, which I thought was very unique, and uh, I know there's other places that also farm in the United States, but of course, the Central Valley is the best. And I was like, oh, this is helpful for us. Is if you are a farmer and you're planning on selling your farmland, and you're not trying to do a tax-free change, and you're just getting out of it and you're going to take the gain. Well, what this new bill will allow you to do is if you sell it to another qualified farmer, then you can pay out that capital gain tax over 4 years. And so that's a tax-free thing. You just do it over 4 years, or sorry, not tax-free, interest-free, over that four years. And it's just a way to help you defer that tax hit. But again, dead horse, there's rules to this, and you need to specifically have a covenant within your agreement with the next farmer that they promise, or maybe this is getting into the legal side, an attorney will have to chime in on something like this, but there has to be a covenant in there that the buyer is planning to use that farmland for the next 10 years as farmland. So another instance of talk to your CPA before you do something, because otherwise, if this was after the fact, there may not be anything we can do. All right. So individual tax law now, which maybe hits more home for a lot of people. There's equally a lot of changes here, and I think for especially individuals who have pass-through entities or pay their business tax on their individual tax return, maybe some items that will be even more relevant to you here. And so starting here with tax rates and standard deduction, nothing really changed. For the everyday citizen, things just got extended and made permanent. But what was put in here, and it really was going back to when President Trump was talking about Social Security and the potential of maybe not taxing Social Security income. Well, the way that they sort of got this put in here, it's not explicit that Social Security income is not taxable, is to give an additional personal exemption for seniors. And there's also additional amounts of standard deduction for seniors. So from what they say, in most instances, individuals who receive Social Security, and maybe that's their only source of income, they, in most cases, won't have to pay any taxes on that. Now, if you receive Social Security and you're also taking $100,000 a year from your 401k, or you have a large pension, then you'll probably still pay tax. But in those instances, maybe you're a bit more able to handle that tax payment as opposed to somebody who is on that strict fixed income with Social Security. So you see here, that's where this item is phased out for taxpayers who have income, exceeding 75,000, or if you're married, 150,000. Itemized deductions. The SALT limitation was increased. That was a big deal. It gets phased down based on income. So if you make 250,000 as an individual or 500,000 married filing joint, then it will get phased down. But if not, it's a area that, especially if you itemize, can provide a lot of tax savings. In 2026, the return of charitable contributions made in cash will now be an above the line deduction, which essentially just means that it's not itemized, it's not standard deduction. It just comes directly off the income that you make. There's a few caveats to this. It can't be to a donor advised fund. It has to be specifically to charitable organizations. So something to think of. But what this also plays into is this 0.5% AGI floor for itemizing charitable deductions. So if you give property to a charity and you make, we'll put a round number, your AGI is $100,000. Well, then anything above 500, you'll be able to actually itemize and deduct. But that first 500, you won't be able to. And that's because there's this floor of 0.5%. Home interest remains relatively the same, but now you'll be able to deduct mortgage insurance premiums. And the 2% miscellaneous deduction has been permanently removed. Some other items here for itemized deductions. I don't know if there's any gamblers in the room here. Sometimes I like to gamble, but I don't like to lose, so I don't do it as much. Maybe if I was talking to people in Vegas, this would be more relevant. But I thought it was just very interesting that going forward, you can actually only deduct 90% of your losses. So if you gambled and you made $100,000 off a slot machine, but it took you $100,000 to make that, then you can actually only deduct $90,000, and you have to have a $10,000 gain even though you didn't make anything. The other nuance here too is you can only itemize your gambling losses, so it's not something that comes directly off the top. So if you just gamble a little bit, and let's say you made $30,000, but it took you $25,000 to do, and you have nothing else in your itemized deductions, then maybe you just use the standard deduction, then you sort of lose out on even trying to do those gambling losses. So for the people that go to Tail Mountain, Chancy a lot, and Big Winter, just an area to think about for sure. And then last one there, itemized deduction phase outs have been so just the nuance to it. I wasn't going to go into the detail. If you're near these phase outs, then it may be of importance to you, and it may have already been if you were itemizing before. So something to think about as those things potentially will be phased out based on your income. And another big one, qualified business income. So the deduction was made permanent. The threshold phase out amounts were increased. And you can see there on the slide, it's limited based on what your income is. The other thing that the new bill did is it started including disallowed itemized deductions. And what this essentially just does is lowers your income, or lowers your calculation of your income for your QBI, which then makes it to where potentially you're not going to be able to do as much. And the other thing here for small business taxpayers, if you have at least $1,000 of qualified business income, then you'll be able to get a minimum deduction of $400. And then some of my favorite ones here, these above the line deductions that were a big hot topic. And again, may not relate to everybody here, may relate more to your employees, but no tax on tips, no tax on overtime, and no tax on qualified car loan interest, which seems very, very cool. But again, there's rules to all of these things. I wish that accept payment and just easy, right? Well, no, they thought of that, and so the Treasury has sent out a list of qualified jobs to actually be able to not take tax on tips. And so that'll include occupations like food service, hospitality, hairdressers, things like that. And if you fall outside of that, you're a CPA, you're not going to be able to deduct tips. And then the other thing too with tips and overtime is there's thresholds. So if you make $50,000 in tips, you're not going to be able to deduct 100% of those $50,000. It's only up to $25,000. And then the tax on overtime is only up to $12,500 for individuals and $25,000 for married filing jointly. But also, one of the keys there is you can't double dip in both of those with tips and overtime. So something to think of if you're in that situation. And then the qualified car loan interest, there's income limitations to that, but I'd say one of the keys there is that if you have a vehicle that you think you want to potentially take this deduction, then you need to make sure that it's something that the assembly is completed in the United States. And that goes back to the Trump administration's goals of bringing everything domestic. They don't want to give a deduction to vehicles that are produced, built in, final assembly in another country. So what we'll see usually here a lot is there's a lot built in Mexico. So you may want to look at that. If it just Ford Motor Company, I know they have facilities here in the United States, but they have facilities in Mexico. So maybe they have one car that will apply and one car that won't. So something to think of, and if the situation applies to you, something you should talk about with your tax professional. All right. So just some other items that I thought were interesting and important to know. Small business stock. This potentially allows you to exclude 100% of the gain on the sale of corporate stock. So if you have C Corp, the business actually pays taxes. There's so many rules to this. So I don't even want to go and take a deep dive into this because it would take much more time than we have. But if you have a C Corp that you founded that has been around 5+ years, then it may be something that you talk about with your tax professional to see if you have a goal of an exit plan, and this could potentially align with that exit plan to help save you money. Another one is Trump accounts. I have 2 little kids, a 7-year-old and a 4-year-old. Too bad they weren't this bill, because for children that are born after this bill was put in place, they'll get $1,000 credit into their Trump account, which is essentially like an IRA account. There's uses for it. You can use it for potentially some education expenses, but really it's just an account that will grow and the child can have when they're 18. So we'll see how this goes. It's not something that is currently fully functioning. I think they're still working on it, but potentially something that could be fruitful for our youth. And then expanded education and child tax credits. As I mentioned, having 2 little kids, I always like to hear those words. Expanded child tax credits. It's not like it even comes close to covering the cost of having little kids, but anything helps. And it's nice when our government will help us a little bit in the struggles of raising kids. And that was really all that I had for individuals. I didn't hit everything. I don't know what everyone else uses for your own tax research. If you don't necessarily research, talk with your tax professional, you find information on YouTube or TikTok. I will say that there are some influencers or some professionals on YouTube or TikTok that I've watched and listened to, and they give good advice. So just be very careful. It's the same thing as when I was growing up. The teachers didn't let us reference Wikipedia, and that's because anybody could put stuff on Wikipedia. It's the same thing. So make sure that if you're listening to somebody and they're giving tax advice, that it is actually something that is real and is supported by something, or it's somebody that you trust. I put a lot of weight behind the CPA name, and if somebody is CPA, for the most part, they're good quality individuals. Of course, there's bad players in every industry, but if somebody isn't a CPA, an EA, or worked for the IRS or has some type of tax background, and they're spewing out tax knowledge, maybe don't listen to them. Or you can listen to them and you can research it a little bit more and see if it actually applies to your situation. So just something to think of. But either way, thank you for listening to me during this time, and I hope you found this very educational. And if you have any questions, feel free to reach out to me or to your own tax professional. it's a very important topic for all of us, and yeah, I hope you were able to get something out of this.
Well, thank you, Shelton, for taking the time to just kind of share this information. What, just one final question before we end. What would you say would be maybe one key takeaway that people could use now going into, as we finish up there? You made a comment earlier about buying the electric car, but before the end of the year. But what is one key takeaway that maybe this group could kind of take as they leave?
I think that the main thing is to plan. A lot of times in taxes, we don't think of it until March, February, April of the following year. And we're like, oh, hey, here, tax professional, or here, me preparing my own taxes. Let me take a look at everything that I did. And then I'm going to fill my. Well, what that leaves you is one, if you think you qualify for something, maybe you didn't check a box or dot an I that you were supposed to. So in that case, maybe you lose that deduction that you thought that you were getting. So it's just very important, especially maybe not now, because our deadline for extensions for pass-through entities is in 5 days, and then individuals is October 15th. So we're busy CPAs. But think about it now. Reach out to your CPA. Maybe they won't be as communicative right now because there's a lot of things going on. But talk about it now. That's the main thing that you can do to help yourself, is to get in front of it. Just do it when you've actually done something. Talk about it and think about it before you actually do something, so that you're prepared and you're making the right decisions for your business and to be tax compliant.
Sounds great. Well, thank you again so much for being here and sharing your expertise. And thank you, Craig, and the payroll people for jumping on board and sponsoring this event.